Welcome back Thursday morning here on Squawk Asia. We're back with Yu-Dee Chang, Principal and also Chief Advisor, Ace Investment Strategist, staying with us live over in D.C. Yu-Dee, before we went to the break, you were talking to us about how a pullback in the market would be a good opportunity to get back in. What could be a trigger for that pullback?
Well, I think there's higher oil prices is definitely one. Like you were saying, oil prices around $103 per barrel. I think the magic number everyone is talking about is about $120 per barrel. Basically, most experts would agree if the price of oil does go above that, that is going to have a major impact on the U.S. economy and the recovery. So that could be one. Some kind of turmoil continuing in Mideast or North Africa, resulting in higher oil prices, higher gold prices, choking off the economy, triggering this so-called pullback in the stock market.
Yu-Dee, at what point do we start worrying about the risk to earnings for companies as well? Again, coming back to this beige book, the numbers that were coming out saying that companies are now passing on the increased import costs. At what point, though, does that impact volumes for many of these companies, even if margins are protected?
Yeah, I think eventually it would. But right now, companies are getting much more efficient. So although their costs may be a little higher, but because of the efficiencies, they're still getting their bottom line. But you're right, though, Karen. I think we're pretty much at the moment of truth, meaning this. I think prior to the last quarter, a lot of these revenues, or not revenues, income that is still coming from cost cutting. I think going forward, if these U.S. major companies were to start to make real money, it has to be from top line growth or revenue growth. So that's why people are starting to put emphasis on the fact that, well, maybe these higher energy costs or even higher commodity prices or food prices, that is, eventually it's going to bring up the cost of these companies. And if the companies do not raise their revenue, it's going to hurt earnings. So I don't think at this point in time, the concern is as much yet. But I think going forward, it would be a concern if we see continuing high prices in all type of commodities.
Okay, so something to watch out for. You know, if we look at the market performance and reaction, sentiment out there still seems to have improved a little bit, even if it was jittery at the start of the week. What does this mean for payrolls at the end of the week? Because there are some fairly big expectations out there on the markets. If there's a disappointing number, are we going to see a market overreact because of the type of sentiment we've got out there?
Yeah, that's a possibility too. Right now, market is pretty much on target as far as both earnings and revenue is concerned on the so-called beat rate, meaning on earnings we're about 66%, beating expectations. On revenue we're about 69%. So they're pretty much on target, and they're actually having great expectations. You're absolutely right. If somehow this quarter's earning comes in and does not beat as much, they might result in a little bit of disappointment and triggering correction in the markets as well. There's a lot of things, and like you're saying, the employment numbers, we're expecting such a good employment numbers, actually 180 to 222,000. So if we don't get that number, probably, at least on the short-term basis, will result in a little bit of disappointment too, and possibly triggering a little bit of correction in the market. And also keep an eye on the so-called VIX index. It is at a level where correction starts.
Okay, so watch for the fear gauge. Thank you very much for the perspective today, Yu-Dee Chang from Ace Investment Strategists. In other news we're following for you, India is set to clear Vedanta Resources acquisition of